One of the first things I learned in this profession is that the MD&A, management's discussion and analysis, is the heart of a company's disclosure. Today on Zippy Point. I'm Brock Romanek and I'm a big fan of yous. My first job out of law school was working at the SEC in the Division of Corporation Finance. It wasn't too long after I got there that the SEC put out some interpretive guidance about MD&A, and it was really drummed into us that this disclosure was the heart and soul of a company's disclosure stream. At that time, in the late 90s, MD&A disclosure often was a mere recital of the numbers in the financials. One number compared to another number with a percentage sign. It really was a whole lot of nothing, or actually a whole little of nothing. The MD&A section itself might have spanned a page or two. Today it's a lot longer. So you really need analysis, just not discussion. That's what the A stands for in MD&A. So the staff issued a lot of comments in the area back then when I started out in an effort to improve the disclosure and really drum it into people's head that the interpretive release had come out. You know, this is back before the internet, where the SEC could put out a new interpretive release and no one would hear about it for more than a year. So things sure have changed a lot over the past 30 years. We won't get into that. So before I bring on our guests to talk about MD&A in greater detail, let me run down some of the basics. The legal requirements. Item 7 of Part 2 of Form 10-K refers to MD&A. So MD&A is required in the 10-K because it refers to Item 303 of Regulation SK. That's the regulation that elicits the MD&A disclosure. And then Rule 14A3B also lists this disclosure by referring to Item 303 in the glossy annual report, which is typically then incorporated by reference into the 10-K, or if it's a 10-K wrap, it resides in the 10-K portion of the wrap, or it might be in the glossy part of the wrap, one or the other. You're also going to have some sort of MD&A discussion in your Form 10-Q, your quarterly report, as required by Item 2 of Part 1 of that form, but it won't be the same as your 10-K glossy annual report disclosure. That's full-blown. We'll talk about that in a little bit. MD&A is so important because it not only brings the financials to life, but it's one of the few places where forward-looking information might be found in your SEC filing stream in a 10-K or in a 10-Q. And the fact that the CEO, CFO certifications extend to MD&A truly brings home the point that this is important disclosure. See my vid guide on what those certifications are all about. The MD&A typically is at least a few pages long, and it's a joint product of the finance and your legal departments, along with some help from the independent auditors and perhaps some other contributors. You might have your outside law firm involved. In addition to that 1989 interpretive release that I mentioned, the SEC has put out other guidance over the years. A very important interpretive release came out in 2003. That bears reading for sure. And then there's actually a new interpretive release that came out early in 2020, which you should read. It focuses on key performance indicators and metrics that companies might use. Our guests are going to talk about that new release. There definitely is a trend towards using non-GAAP measures in MD&A, and that trend will only accelerate after this 2020 release. MD&A really is not a check-the-box exercise. You need to sit back and really think about what your investors would want to know. This is a principles-based regulation. And think about how you would disclose things in a way that can be easily understood. So you might up with disclosures in this section in the MD&A that on their face wouldn't seem to be a good fit because they're not so financially related. Litigation is a good example, related party transactions, and even intellectual property risks, anything that might impact your bottom line. Some of these types of disclosures are covered in different sets of what are known as the CF disclosure guidance that the Division of Corporation Finance, CorpFin, occasionally puts out. And then you also want to review Topic 9 of CorpFin's Financial Reporting Manual. What to disclose. So in addition to providing whatever additional information you need to make so that investors have a full understanding of your financial condition, changes in your financial condition, and results of operation, again, this is a principle-based disclosure requirement. You look deep within. Item 303A of Regulation SK has 5 specific disclosure requirements: liquidity, capital resources, results of operation, off-balance sheet arrangements, contractual obligations. Money companies also include a section about recent accounting pronouncements, even though that's not called for by item 303. And then they also address accounting policies and estimates in the MD&A routinely, even though that's also not specifically called out by 303. So before I dig into each of those, let's discuss how MD&A might be structured. The SEC encourages the use of a summary in the MD&A. It's not required, but it was recommended in the 2003 interpretive release. The SEC also encourages the use of layered disclosure, where each section begins with a preamble of sorts and leads the reader up to full understanding. The SEC wants you to use informative captions for the headings and using tables, graphics, charts where appropriate to help readers understand. So this is supposed to be a usable disclosure. Of course, all disclosure should be usable disclosure, but the SEC takes pains to really guide you that way for the MD&A. As far as how far back you go in your 10K, it can just be the last 2 fiscal years. Instruction 1 calls for the period covered by the financials, which is 3 years, but then Instruction 1 goes on to state how you can drop the earliest year if it was already disclosed in a prior SEC filing, which it would have been unless you're a brand new company. You just need to state which filing it was that had those earlier years. This ability to drop earlier year disclosure was just adopted in 2019, and so far not many companies have made the switch. They've been hesitant, so a lot of companies are still providing 3 years worth of MD&A in their 10K, and of course that's permissible. Okay, let's talk about known trends and uncertainties. Known trends and uncertainties. So when I'm in the staff in the late 80s and that interpretive release came out, this is really what the SEC was driving at, trying to get more forward-looking information in the SEC filings, which of course this is the kind of information that investors most want. And of course, this is also the kind of disclosure companies least want to give. So you'll be discussing known trends and uncertainties quite a bit in your MD&A. It's a requirement that really gets you thinking. Different people in your company are going to have different thoughts about what you should be disclosing. So if you have colleagues that are hesitant to disclose any known trends and uncertainties, just point them out to some of the SEC enforcement actions brought over the years, because hindsight is 20/20, and so it's easy for the SEC enforcement division to say, hey, do you have evidence that you knew about this trend? Of course, yes. Then why didn't you disclose it? Because it happened and it was not good news, and the stock price went way down. Hindsight is 20/20, but you need to have valid reasons why you didn't know about a known trend. You can't be ignorant that you should have known. And so you got to train your business people to bubble up trends to the attention, at least the more senior people on your disclosure committee, so that when you get together in a drafting session, someone mentions, hey, maybe shouldn't we disclose something about this? And you're like, oh, I didn't know about that. We should put that in. All right, so how do you think about all this from a regulatory standpoint? The SEC has set forth a 2-step analysis of determining when known trends and uncertainties must be disclosed. That analysis was in the 1989 release, and you can read it here. This analysis differs from a traditional materiality analysis. It's a lower disclosure threshold. So number 1, is a known trend likely to come to fruition? If management determines that it is not reasonably likely to occur, no disclosure is required. Not reasonably likely to occur. That's a key term here. And number 2, if management can't make that determination, it must evaluate the consequences. And then disclosure is then required unless management determines that a material effect on the company's financial condition, results of operations is not reasonably likely to occur. So we have the term of art that we have to consider. Like I said, this is not the same analysis you do for your materiality analysis. This reasonably likely to occur test is not the same as a probability magnitude materiality test in Basic v. Levinson, that U.S. Supreme Court case from the late 80s. The SEC has repeatedly said that. So why is making this disclosure so hard? Like I said, this is forward-looking disclosure, and anytime you have forward-looking disclosure, you worry about getting sued if you're wrong. You worry about turning your disclosure into a self-fulfilling prophecy. It's really hard to get the company to put themselves out there. And you should also be worried about the duty to update. So this is a real hassle. You have to really be careful how you couch this disclosure so you're not tagged with a duty to update where you're continuing to have to revisit the disclosure every quarter in your 10Q. This is definitely a good area where you want to see what your competitors are saying, what they're disclosing, what's a known trend for them, should be for you in many cases, at least when it comes to the industry stuff. And then there's the known trends that many companies are universally facing, the kinds that are so important that the SEC puts out their interpretive guidance just in that area. So these days it's climate change, cybersecurity, and of course, COVID-19. So let's move through the 5 items required to be addressed specifically by item 303A. The first one is liquidity and resources. These 2 items are almost always combined as one section in your MD&A. Under instruction 5 to item 303A, it defines liquidity as the ability of your company to generate adequate amounts of cash. And then capital resources is not defined, but it's cash or other assets that's convertible to cash that are available to spend on capital, things that you need to buy. So you're going to describe these things in the context of your own business, of course. You're going to evaluate liquidity on both a short-term and a long-term basis. You're going to touch on your cash flow situation. You're going to describe any projects that what might require a significant capital expenditures outlay. And then of course, you're going outlay. And then you're going to describe your known trends and uncertainties. So you want to look at the 2003 interpretive release to get a good handle on what you need to do for these 2 sections. Results of operations. So for the results of operations, item 303A3 has 4 specific disclosure requirements: unusual events, known trends and uncertainties, narrative about material changes in sales and revenue, and then how inflation and changing prices is impacting your company. Known trends and uncertainties will be a big player here. Off-balance sheet arrangements. So this disclosure can be messy. Look at the size of this requirement under item 303A4. The accountants luckily take the lead here. There are a number of accounting pronouncements that come into play. There's actually, SEC has their own off-balance sheet rules. And then you look at the accounting literature, the FASB pronouncements. And then 303A4 provides that the disclosure of off-balance sheet arrangements must include 4 items: the nature and purpose, the importance for liquidity, capital resources, market risk support, and credit risk support. 3, financial impact, and 4, known trends and uncertainties. Comes up every time. Contractual obligations. So here you'll have a table for sure. This is required, and you'll see it here in item 303A5, what the headers should be. And this table, of course, will have footnotes. The table gives you the format, and then you'll have this table has a list of the contractual obligations your company has, organized by type and by payment. Recent accounting pronouncement. As I mentioned earlier, many companies include this section, even though it's not required. The disclosure tracks SAB, Staff Accounting Bulletin 74, which is topic 11M in the SAB codification. And of course, the auditors are going to drive this disclosure. You're going to explain how a recent accounting pronouncement did or will have a material impact on the company's results. Accounting policies and estimates. MD&A typically addresses a company's policies and estimates too. There's no specific requirement. There was an SEC proposal about this way back in 2002. I do remember that well, under the name critical accounting policies, but that was never adopted by the SEC. It was controversial. This is just a challenging area. And again, luckily the auditors are going to take a lead in this. So I know I'm breezing through all this stuff and paraphrasing a lot, so you're going to have to always read the regulation, and in this case also read the interpretive releases. But because to get to know all you really need to know for MD&A would encompass a full day course, and maybe one day I'll put together a workshop on that. There really is that much involved. So this is all I can realistically get across in a simple video. Form 10Q. So the MD&A and the 10Q is different than for the 10K. It's not a full-blown disclosure like it is for the 10K, but it still does involve quite a bit of work. Item 303B is the driver here. It requires the company to discuss material changes in financial condition and results of operations. Instruction 3 to item 303B says you can presume that investors have had access to your 10K MD&A. You know, it's online. So you look back to what you disclosed in your 10K, you look back to what you've disclosed in your interim period since in each of your 10Qs, and you have a discussion with your people, your disclosure committee, about what has changed over the last quarter, and dig into that, updating what you need to update. And this includes updating, of course, your known trends and uncertainties as they shift. Safe harbors, item 303C and several places in the item 303 instructions mention that any forward-looking information in the MD&A is covered by the safe harbor rules for forward-looking information for projections. So the SEC is trying to reassure you that bad things won't happen if you provide forward-looking information. They're trying to draw that out of you. But of course, bad things can still happen despite those safe harbors. I have a separate vid guide about forward-looking information and the safe harbors that are available. Our guests today are Scott Kimpel and Olga Khavatskaya. Scott is a partner of Hunton Andrews Kurth here in Washington, D.C. He used to work at the SEC as a counselor to Commissioner Troy Paredes. Scott is one of those go-to people for me. He seems to know everything about the securities law and corporate law. Olga is Assistant General Counsel and Assistant Corporate Secretary at Philip Morris International in Switzerland. Very excited to have Olga. I'm Brock Romanek, today on Zippy Point.
Quick Zips by Zippy Point.
Quick and dirty. Thank you, Scott and Olga, for talking about what is really the heart of all disclosure matters, MD&A. When I first got to the SEC, one of the first things that got drummed into us was how important the MD&A was. It's partially because of the timing of when I got there, late in 1988, and the SEC actually put out some interpretive guidance about MD&A in 1989, which was, back then they didn't come out with new rules, new guidance as fast as they do these days. Back then, the agency might do a new rulemaking once or twice a year, interpretive guidance on something, like every 3 or 4 years. These days, it's obviously much more common to get guidance. So it was a big deal, and we got trained in the new MD&A. So that was really one of the first things I actually learned about what we should be doing, because back then, MD&A was pretty rote in that it would, some companies were just literally repeating line by line from their financials in the MD&A, and it was like a one-page section for some companies. So Olga, let's bring us up to modern times. Who drives the MD&A disclosure process?
So at our company, the disclosure process for MD&A and maybe other disclosure topics is a true collaborative effort. And the two drivers are the legal department and the financial group that's called accounting and financial research. So all in all, it's a collaborative process, and we feed off of each other throughout the year. What's interesting in our company is because the issues come up so frequently throughout the year, the process doesn't start at the inception of your calendar 10Q process date. It's really throughout the year. But for simplicity, yes, there are legal sections and financial sections. So I drive the review and preparation of the legal sections, and the accounting department runs through or drives the liquidity section, financial review, and the discussion of the financial results. So in my responsibility, the following sections are included: the legal proceedings, regulatory update, we call it business environment, and risk factors. I drive those three. Having said that, I don't drive them solo. We have our colleagues who are point persons from other departments who provide me feedback and allow me to have a dialogue with them and effectively interview them on all of these emerging issues. And then everything comes together for the formal disclosure committee meeting, where we present the full document for review, and we go over the various topics at that meeting.
And what about the independent auditor? When do they get involved, or do they get involved in the MD&A?
So the independent auditor's role is really more focused on the pieces that they audit. They do review the MD&A part, and of course, it's a formal process. They provide comments, we consider them, but it's a different process from the rest of the 10Q that they actually do audit. We actually like the collaboration with them. Their comments stem from essentially the same sources. But what they have, which I don't have, is the experience with other clients, other industries. So that's really helpful. And they also serve as that third person outside the company that you sometimes need to have in order to provide a fresh perspective. So they give that to us and we appreciate it. But as we do, they go to our statements, our prior disclosures, some internal communications, news media, SEC comment letters, all the rest of the sources that we also would be looking at throughout the process.
Scott, what's been your experience working with your clients and in particular the audit committee? What do you find to be their role?
Yeah, so most audit committee charters reserve a role for the committee in the review of MD&A as part of their larger responsibilities. Often that's done in tandem with the financial statement review that they'll perform with management and the external auditor in the run-up to filing a Q or a K. In my experience, the committee usually does not propose lengthy rewrites or provide long riders. Instead, their comments and comments from the full board to the extent the board weighs in tend to be more directional, tend to be more strategic. Usually this process is kind of late in the game. Occasionally I've seen audit committees that get involved on the front end and say, look, we need to change the narrative this year to reflect this issue or that issue. Again, they're not rewriting the whole thing, they're just giving management some direction on that. But I think it's more common that they're sort of the last look after it's been through the multiple rounds of review with the company. Folks like Olga and her counterparts on the financial reporting side have gone through it. It's bubbled its way up to the senior management and the C-level executives, and it's in near final form, and then the audit committee gets kind of one last look at it. And at that point, occasionally we'll have comments, but usually by that point it's done and they're just ready to move on and get filed.
If they have comments, do they typically send them in before they have an actual audit committee meeting? Just as each person is done reviewing them, they'll send them back?
Yeah, I mean, different companies manage it different ways. Some of it depends on the chair and how he or she is wired. Some committees, the chair prefers to be the only one who has any interaction with the CFO or the CAO. At other companies, it's more of a collaborative effort, and you do have individual committee members that have that direct dialogue with senior management. It can be done either way. Again, though, I mean, it's usually more the exception than the rule that they have heavy edits to anything. They've usually been involved in the process thematically earlier on, and that's sort of where they telegraph what they want to see.
And then, Olga, tying back to your role, the lawyer's role in this process, I assume that typically you're the primary drafts person, that people are sending the comments back to you? Right.
It's me. So I do several things. I collect input, I draft, I run, I take the process forward. I also, on new issues that I just need to knock on people's doors, I need to talk to management, right? Because MD&A is presented through the eyes of management. So on new emerging issues, I collect the input. I look at the various comments that I get. Obviously, I'll have to run through the legal analysis and a lot of these comments. And then I talk to management. I talk to various people tasked with the specific issue or resolution of this issue, just to see if it's MD&A material. Is it something? Is it nothing? Is it worth further discussion? Sometimes the conversation leads you in other departments. So you have to talk to finance. Sometimes you need to understand if what you're talking about is material quantitatively. So then you talk to finance. I run with these issues, as we say in the corporate world, and ultimately my responsibility is to draft these sections. The section I'm talking about now is business environment. So obviously it's a collaborative effort. I need to run things by many different people, but when we present these sections to the formal review at the Disclosure Controls Committee, that's me.
Are you using the equivalent of like a data room, a deal room, where there's sort of a master copy and people submit their edits and that's all combined on one document that's redlined in different colors, or how does that work?
Ultimately, yes. We have this wonderful tool, the Workiva, where various departments put in comments to the document, and that's the managing software that also allows people to review and comment. Of course, there's some discipline on the drafts and processes, who can draft what section when, but ultimately that's the compendium of all of the comments that you can just reverse engineer if you need to see what group put in what comment, and then if necessary, ask for an explanation. So yes, that's that. I mean, of course, if you talk to lawyers, there are other side bars that you don't necessarily document all that rigorously. If you have a conversation that winds up in nothing, you wouldn't be creating these documentation that is all that extensive. You just, your own notes or your own files would be enough.
Yeah.
Yeah. Also, maybe a process point, certain things need to be documented pretty well, but all of these discussions that are just taking temperature and certain regulatory risks or new regulations that emerge, that's more done colloquially.
So Scott, as we're taping this vid guide, the SEC just adopted some new SK rules that will require companies to fine-tune their written disclosure controls and procedures. What sort of written controls and procedures do companies have for the MD&A?
Yeah, I mean, some of it is just as Olga described in the preparation process, where you have the people who are closest to the issue doing the first draft of it, and that tends to be something that provides a lot of discipline in ensuring that content is appropriate. Beyond that, again, as Olga alluded to, most companies have a process where different business subject matter experts go through the drafts and provide comments. And again, you're ensuring that everybody has a seat at the table. Sometimes that process is memorialized in a checklist or some other formal sign-off document so that you have a written record that each of these 10 people has approved it, or it could be a much larger number in a much larger company. Sometimes it's a less formal process, particularly at smaller companies. I think the main thing that still a lot of our clients use is the subcertification process. And it starts with the certifications the CEO and the CFO have to make under Sarbanes-Oxley, and then kind of working your way down from that to different business functions to ensure that the leaders of those teams are certifying up to the CEO and the CFO. Sometimes it's almost verbatim to what those senior executives have to say. Other times it's more tailored. You may not have the HR function, for example, entirely commenting on financial statements because that's outside their area of expertise, but at least you're getting bits and pieces of it. And I've even seen at some companies, sub-certifications to the sub-certifications. So, you have the general counsel making a certification to the CEO that I've read it and it, checks all these boxes. And then the general counsel turns around and has all his direct reports, and maybe even direct reports do their own certifications. And particularly at companies that are involved in a lot of litigation or involved in other legal proceedings of one kind or another, you want to make sure that you're capturing all that. And the way to do it is to go around and just poll everybody. So that's the most common tool I've seen. There are other approaches as well. Sometimes it's just, as informal as an email back and forth. Did you read it? Yep, looks good. Or, do you have any comments? I tend to like something that's a little bit more structured, though, where you do have some checklists, because you're creating a written record that all these things have been done, and you pair it with a document management system like the one Olga described. So you've got a really good record now that all the right people review these things. And if I'm the CEO or the CFO, it gives me a lot of comfort that, it's not just me going out on a limb here, but we've got a process underneath me that's been rigorous.
Yeah, I just taped a separate vid guide about the CEO certification process. It includes interview with a couple of people about the sub-certification. And it's funny because I hadn't explored that topic. It was such a hot topic back when the CEO, CFO certifications first became a real thing after Sarbanes-Oxley. And then there was a lot of talk about that. But, you go to a conference these days and it almost never comes up. So if you want a half hour on that, check out that vid guide. So can you talk to us, Scott, about the SEC's 2020 interpretive release? What types of disclosures is the SEC trying to elicit now?
Sure. So this came out in late February of 2020, and it focused on the SEC referred to as key performance indicators and metrics, so-called KPIs. Just a few weeks later, the whole country shut down due to coronavirus. So the release may not have received the kind of attention the commission hoped for, and they quickly had to pivot and deal with more pressing matters. But briefly, KPIs are the key variables and other factors. They can be quantitative or qualitative that are both peculiar to and necessary for an understanding of a particular company. The guidance provides some examples. Oddly enough, they're buried in a footnote. It's footnote 11 if you want to look it up. And they include things like same-store sales, sales per square foot, total subscribers, number of memberships, energy used. These things will vary by industry, but you're starting to get the idea. They tend to be very customized metrics. And the thrust of the guidance was to remind companies that if you're using KPIs, and they are material, as we all understand materiality, then they may be worthy of discussion in the MD&A itself. If you're going to discuss them in MD&A, the guidance goes on to say that the SEC would expect a clear definition of the metric, an explanation of why a company thinks it is important to investors, and a description of how management uses it to measure performance. Since the guidance came out, I've seen some companies that have increased their disclosure or even started using headings to sort of cue the reader to that's what they're doing. But it's by no means a global movement, and not every company uses these metrics, and some that don't do it to provide financial information. They do it because everyone else in their industry is doing it. For example, it's hard for a retailer not to report on same-store sales. It's kind of expected. This is an area the SEC has monitored some. Again, I think because of coronavirus, they've been giving companies a little bit more room, but there have been some comment letters. One of the early ones went to News Corp. That got a lot of attention when it came out in the spring of 20. Basically, the staff said, hey, we've been listening to your earnings calls. You talk a lot about metrics like broadcast subscribers and unique users, but gosh, you don't really talk about these things in your MD&A, and maybe you should. Of course, the company wrote back, and as companies often do when you get that kind of comment, and they said, oh, mea culpa, of course, we'll talk about these things in the future, and here's how it will look, and that's how they cleared the comment. So, for some companies, this is very important. For others, not so much. Like anything in the securities laws, it's very, very dependent on what your industry does and what your unique circumstances are.
So how about segments? How do you determine what segments your company has?
That's an area that comes from the accounting literature and GAAP. The main place that you look is ASC 280. It describes a management approach, quote unquote, that focuses on how management has organized the entity, both to make operating decisions and assess performance. As accounting standards do, it goes on in great detail about the different characteristics you're supposed to look at when you're deciding whether a potential segment is a segment for GAAP purposes. And you look at things like whether it engages in business activities from which it recognizes revenue and expenses, whether its operating results are regularly reviewed by the Chief Operating Decision Maker, or CODM. That's an important term for that particular standard. And you see a lot of discussion in the standard about exactly who is the CODM and why they're the CODM. And also you look at the potential segment to look to see if it has discrete financial information that's available. In certain circumstances, it may even be necessary to aggregate 2 or 3 different segments into a single one, and there's various quantitative tests that are used to measure that. There's a lot of additional guidance in the accounting literature on that. I, as a lawyer, tend to step back and let the accountants sort through some of that. These are a lot of subjective decisions. This more so than maybe some of the other accounting standards is intended to have a management approach so that it is sort of like MD&A. It's meant to provide a view of how the business is assessed by management as opposed to just sort of a rote objective set of criteria. Like other things, this is also an area that the SEC monitors and they'll send comment letters on it. I actually have an active client right now, not Olga's company, another client that has an open comment on this issue where the staff has gone in and is second guessing the company's judgments and decisions on this. And they've asked the company to explain further how they went through the guidance and how they went through the standard and how they reached the conclusion that they did.
It's usually the accountants within the SEC, within CorpFin, that are issuing that comment.
That's right. I mean, the letter that I'm thinking of is entirely from accountants. And, you know, we looked at a lot of precedents where similar comments were raised, and they're almost entirely accounting comments, not legal ones.
So Olga, the heart of the heart, how hard is it to determine your known trends and uncertainties? This is the SEC's attempt to get some forward-looking information in the company's SEC filing stream. How do you determine that? How do you know when to stop?
Right, good question. Short answer is it's kind of hard. You start with the legal determination analysis that the SEC gives you, but it's hard. It's a two-step process. You determine if something is likely to occur, and if you can't conclude it's not likely, you need to then move on to the next step, and then you disclose it unless it's immaterial. But before you get to the legal analysis, you need to understand what your inventory of risks and uncertainties and trends, what that inventory looks like. So you can imagine that the inventory is quite vast. You have your tobacco regulation that everybody understands kind of what it is, and it evolves still, but you have your regular excise taxation, restrictions on advertising, and so forth. But then you have an ocean of other regulations. And we can think of regulatory uncertainty as an uncertainty or as a trend in itself. So we describe it. We try to be quite transparent with our investors on what we know, what we don't know, what we'd like to know, where we'd like to wind up. And when you talk to management to understand their perspective, it's very important to break it up in various elements, hopefully the same way they think of these elements. So, for example, we say publicly, and we say it in the 10Q as well, that for us to be successful, we are advocating for a regulatory regime that differentiates between cigarettes and our reduced risk products. Well, we also say we have various challenges. We name what they are, but we also say quite transparently, we can't guarantee that we will achieve what we are asking, what we're advocating for. So we track, and we're quite diligent at talking with our corporate affairs colleagues who can provide us with input on where we are each quarter in these regulatory developments. And it's a tedious exercise. It's also quite refreshing because you get into the nitty-gritty of what they're thinking, what they should be thinking, what you're thinking, what the SEC could be thinking in the end after they read it. And ultimately, is it helpful to the investors to understand what it is that we're telling them? So it is a very hard exercise. When we're talking about regulation, and I've had this issue when I was in private practice, and it's to your point, Brock, where do you stop? If you have a proposed regulation, if you have a kind of a proposed regulation, where on the spectrum do you see these uncertainties, and do you put them in your 10Q? So we are a multinational company. All over the globe, regulatory developments have different trajectories, and you can't just assume that it's the same system as in the United States, where a bill goes through various stages that we all learned in school. It's a completely different regime country by country, and you do need to get into the weeds. Where is this regulation? But we, for example, disclose even regulation that is proposed if we see it's a trend. An example of that is plain packaging. So for a pack of cigarettes in a specific country, there was a regulation that was passed that we could not put our brand names or logos or identifying IP on our packs. And of course, it's a negative for the company. And of course, we disclose that. But then you have proposed regulation of a similar nature in different other countries, and you don't know and you can't gauge where this regulation will wind up. It's proposed. It needs an equivalent of a Senate or Parliament, or sometimes president or king of a country to actually enact this regulation. Well, do you disclose it? So for us, we decided to disclose it because it's an unfavorable, call it a trend or development all over the globe. It's obviously unfavorable. Is it material? Could be material if it's enacted. So under this two-step analysis, you would disclose it, but you probably even might, in the absence of the analysis, you probably would also disclose it because it's kind of a trend and it's not in your favor, obviously. So you can't distinguish your brands. So that's an example of you don't stop, you keep going and you analyze, and you probably would disclose. Another thing we're struggling with, and in private practice, our other clients were struggling with the distinction between a risk factor disclosure and MD&A disclosure. And sometimes they feed off of each other. You see cross references. They're very elegantly done. But what I always remind others and myself, principally, is that MD&A disclosure is not a risk factor disclosure. We're talking about known trends. Risk factor disclosure is crafted as a hypothetical. It's if X, then Y. It's crafted as a maybe something will happen. And here are potential consequences. Here we're talking about known uncertainties. So we need to keep the two separate and distinct. Another interesting practice point I wanted to share is things that are obvious. And that goes back to your question, Brock, and when do you stop? Do you disclose things that are obvious? And the obvious nature of a factor that you're considering could come from a fact that it's publicly disclosed, or it's public knowledge, or everybody gets it. So do you disclose something that's obvious? And the testing of what's obvious for me is it really obvious? The first question I ask myself, is it obvious, or is it obvious to all of us because we're brewing in the same soup? We're all talking about the same issues, tobacco regulation, new products. Is it only obvious to us, or would it be obvious to a regular investor outside of the company? And here's where unless it's confidential information, this is where your friends and relatives come handy. So I test my concepts on my kids, on my mother-in-law. PwC sometimes, our independent auditor, comes in handy because they have this broader perspective that we tend to lose in-house. Outside counsel comes in handy to just share a breadth of experience. So this is not an easy one to weed out what's obvious and what's not so obvious. And as we all know, just because something is in public domain doesn't make it not disclosable. We have, for example, in the regulatory development example I described, all of these regulations, proposed, not proposed, final, they're all in public domain, but you still need to encapsulate what is it that we're talking, what is management thinking? It's the known trends and uncertainties. We need to convey this information to the investor in this queue.
Yeah, those are some great points, some great practice pointers. And that's interesting how risk factors is different than MD&A cautionary language. Of course, when you have forward-looking information, you're always putting yourself a little bit more at risk out there. Scott, how do you see mixing risk factor and cautionary language into that?
I mean, that's always been the tension in MD&A, is the commission pushing and encouraging registrants to disclose forward-looking information and trends. And, in some cases, like if it is proposed regulations, that's one way to look at it. But, what do you do with other trends in the business that, are more financial or economic in nature that are harder to suss out? we're seeing that especially now with, again, coronavirus and several releases from the commission and several speeches that the SEC chairman has given, begging, pleading with companies to provide as much color as they can. And if you do, we promise we won't bring enforcement cases against you. But I think, it goes back to basic concepts. Every Q and K should have a very thorough forward-looking statement disclaimer, ideally up front. One that's not overly generic, one that's updated regularly to reflect the most recent developments. If you're using the same language, report after report, year after year, it's probably time to give it a fresh look. I've seen some companies that also include kind of a mini forward-looking statement warning at the front end of MD&A itself that says, look, guys, we're getting into some forward-looking territory here. Management doesn't have a crystal ball, so these are our best assumptions, best estimates, that sort of thing. Otherwise, it's a balancing act, but I don't think companies need to be shy about using phrases like we believe, we intend, we anticipate. Those can do a lot of work, particularly if it's something that you're not sure about, or that is, something you're trying to predict in the future. And I've been involved in litigation, with private litigation in an SEC enforcement cases, and kind of on both sides of the V there. And the presence or absence of that kind of language can be very critical to particularly a defendant making its case. So don't be afraid to use it when necessary.
Yeah, that's why we're getting paid the big bucks and disclosure lawyers. So Olga and Scott, thank you so much. Olga, I know it's pandemic times still, even in Switzerland, but thanks so much for actually going into the office to make sure your internet connection was solid. But I am jealous that you're in Switzerland. I need to travel.
Come visit.
I need to transport myself like in Star Trek. Thank you very much.
Thank you. Thanks so much.